Well, good afternoon, everybody. Thank you for joining the Steward Advisors Socially Responsible Investing webinar. We may have a couple more people joining us, but to honor everybody's time, we're going to go ahead and get started here. Just a couple housekeeping items before we get into the presentation. As you join the session, you've been put on mute just to make it a more enjoyable experience for everybody else listening. We've got everybody on mute. So if you have questions throughout, please feel free to go ahead and send us your questions using the chat feature. If you haven't figured out where the chat feature is, if you move your mouse on your computer, there should be a box that shows up that allows you to click on chat, and you can type in your questions there. We're going to be recording this session, so if you know somebody that is interested in this topic that wasn't able to join, we'll be posting it on our website, and people can access that for a future listen at their own convenience. So the topic today is socially responsible investing, but before we get into that, I just want to introduce who I am and my co-presenter. I'm Tim Obendorf, president of Steward Advisors, and with me is Dale Branda, our chief operating officer. And just a little bit about Steward Advisors. We're a family-oriented wealth management firm, and we focus on helping families make wise financial choices. So we start with people's values and try to develop a deep understanding of our clients' goals and their financial situation, and then integrate our financial planning and investment strategies to meet their values. So one of the reasons that we're very excited about talking about this topic is that it's a topic that helps align people's values with their investments. So for our agenda today, we're going to spend about 20 minutes just giving you a short overview of socially responsible investing. And we'll start out reviewing some common terminology. There's a lot of different labels that you may have seen related to this topic, so we'll talk about what some of those are. We'll go into the history of socially responsible investing, and then bring it up to today's date to give you some current trends and data tools that are available to help understand the socially responsible investing landscape today. We'll have a case study where we look at an actual example of how socially responsible investing can be difficult, but at the same time that you can achieve some of your goals. And then we'll talk about our approach to socially responsible investing and how to actually get started if you're interested in going further. So some of the terms I'm just going to run through fairly quickly. You may have heard of some of these. Community investing, that has kind of a geographic aspect where your investing helps to improve the economy or well-being of a specific geographic area. Ethical investing, which in a lot of cases relates to screening out certain types of investments, so maybe pornography or tobacco or alcohol. Green investing, which relates to investments that are helpful to the environment, so it may be screening out investments that have a carbon footprint, or do some other damage to the environment. Impact investing, which is kind of a combination of investing for your financial return, but also to have a specific impact on some social issue that you're concerned about. It may be affordable housing, it could be child welfare. There's a number of areas where you may have a specific focus around a specific issue that you want to have an impact in. Mission-related investing, which is really focusing on certain types of things that you're trying to accomplish. So again, this could be things like gender pay equity, could be social justice. There's a number of things that could fall under that label. Responsible investing, and then the term that we're going to focus on is socially responsible investing, which integrates a number of these concepts, and we'll define that a little bit further in a minute. Sustainable investing, which while it may touch on some of the values and ethics in some of the other types of investing, it's really focused on how do you invest in areas that create economic value but leave the culture and society and the world in a better place for the next generation. Values-based investing, kind of another term for ethical investing. And as I mentioned, we're going to use the term socially responsible or sustainable investing. So that's really the focus and kind of where the market has evolved to, where most investors are talking about socially responsible or sustainable investing. Now, a little bit of history on socially responsible investing. This goes back maybe longer than a lot of people think. Back in the 18th century, there were a number of religious organizations that in particular were opposed to slavery and alcohol consumption. And so they invested in businesses that didn't have anything to do with slavery or alcohol consumption, and they divested of those that did. And one of the early groups that began doing this type of investment was the Quakers Society, and they created the Friends Fiduciary Fund, which has existed since 1898. Now, the Quakers focused on their philosophies of peace, simplicity, integrity, and justice, and they continue to manage that fund today to those same principles. The first public offering of a screened investment fund was in 1928, and there was an ecclesiastical group in Boston that established the Pioneer Fund, and that's a fund that's still in existence today. Bringing it forward a little bit, we saw in the 1960s where university students were protesting in opposition to the Vietnam War, and they called on their administrations of their universities to have the endowment funds of the universities divest from companies that benefited from defense contracts and other activity related to the Vietnam War. Then in the 1980s, we had socially responsible investing focused on screening out investments that had to do with South Africa, with the goal of pressuring the South African government to end apartheid. And when in 1993, when the de Klerk administration took steps to end apartheid, there was about $625 billion that was in funds or endowments that were screened to exclude investment in South Africa. Even more recently, we've had some movement around the issues in Sudan. There was a Sudan divestment task force that was established to put pressure on Sudan to end genocide and other human rights issues that were going on in the Darfur region. And the success there was that in 2007, the U.S. Congress passed the Sudan Accountability and Divestment Act, which prohibited U.S. government contracts with companies that did business in Sudan. So it's the whole realm of socially responsible investment has a long history, and it tends to take on kind of the nuances of issues that are going on during whatever era that we're looking at. Today, in the U.S., there's about $8.7 trillion that's invested in funds and under mandates that have some kind of socially responsible aspect to them. And that's a pretty significant amount of U.S. investment. Worldwide, total SRI investment is over $23 billion. In the U.S., it's actually the fastest growing area for socially responsible investing. Grew 33% since 2014. The European investment community has actually been a little bit ahead of the U.S., so a significantly larger amount of investments in the European communities are focused on socially responsible investing, but the U.S. is growing faster. In the U.S., much of that investment is focused on reducing carbon emissions. And to give you a little flavor too of what type of investments that is, it's mostly stock-related investments. To put it in perspective, we have $8.7 trillion in socially responsible investing, and there's only about $100 billion of bond funds that are actually labeled green bonds. So the vast majority of these types of screened investments have to do with stock investments. Now, as SRI has matured and become more prevalent, it's kind of gelled around three different areas where investments are screened and where companies are being monitored and data is being reported, and that's the areas of environmental, social, and governance. We'll get into a little bit more what each of those are, but kind of as the names represent, environmental has to do with things that impact the environment. Social has to do with social issues, equal pay, child labor, and so forth. And governance has to do with how transparent and how ethical a company operates. So we have funds and investment criteria based on those, and then there are companies that report on those and provide data to help us actually manage investments in alignment with those goals. In fact, just within the last year, Morningstar, which you may know as a mutual fund rating company, well-known mutual fund rating company, has introduced these environmental, social, and governance ratings for mutual funds. There's a company out there called Sustainalytics, which actually looks at publicly held companies and evaluates them on those same criteria. MSCI is a large market data provider, and they've created a couple of indexes that are based on these criteria. And then one interesting development is that there's a Sustainable Accounting Standards Board. So you may have heard of the Financial Accounting Standards Board, which is in place to guide companies in how they report on their income, expenses, assets, and liabilities. Well, in a similar manner, there's a Sustainability Accounting Standards Board that helps companies determine how to report on issues that relate to environmental, social, or governance issues. One other thing to mention here is that there's a couple different approaches to how you might do sustainable investing. There's exclusionary, so there, as the name kind of implies, you would exclude certain companies from your investment portfolio based on certain activities. So we find this a lot related to ethical issues, maybe in the area of companies that produce pornography or are alcohol or tobacco related. You might exclude those types of companies from your portfolio. Then there's inclusionary, which is where you'd identify certain types of economic activity that are good for the environment or good for various social issues. And you would include those, so it might be something like energy production from renewable energy sources, so you might include those types of companies in your portfolio. Then you have impact investing, I alluded to before, where it's a combination of looking for a financial return, but also having an impact in a certain area. So this might have to do with providing affordable housing. So you might set up a fund that invests in affordable housing and has a goal of not only getting a financial return, but increasing housing availability for a certain group of people. So the categories I mentioned, environmental, social, and governance categories, while they're pretty self-explanatory, this page shows you some of the areas that are maybe concerns under each of those categories. So in environmental, you might have companies that or issues that deal with climate change or air and water pollution, energy efficiency, waste management, water scarcity, natural resources, and biodiversity. Social would be things that might have to do with women's rights, diversity, human rights, labor standards, pay equity, consumer protection, or animal welfare. And then governance has to do with how a company, how transparent a company is, how they compensate their executives, do they have policies in place to avoid corruption, especially as they're doing business overseas? Is the company ethical in the way that it might lobby for issues related to its industry? How do they handle political contributions? So those are some of the areas that the Sustainable Accounting Standards Board would look at, and that other fund managers and investors would look at to evaluate how a company is doing related to socially responsible investments. I'm going to turn it over to Dale to talk about one of the tools that's out there. I mentioned Morningstar has developed the sustainability ratings, and I'm going to turn it to Dale to talk about that.
Hi, everybody. I want to take a couple of minutes to get real practical and talk a little bit about what we are doing and how we're doing it. And as you can see from the slide, by the way, I'll try to do this without getting too nerdy, but this stuff is really interesting. Morningstar, the emergence of data sources to help us sort through sustainability has been a real game changer. Morningstar and MSCI are two of the big tools that are out there. We use Morningstar for a lot of our work. And they have developed over the last couple of years a sustainability rating service. So we can actually pull Morningstar research on the sustainability of the investment as well as its return and all the other financial data that we would normally pull. Morningstar partners with this company called Sustainalytics, and essentially what they do is rate about 5,000 companies worldwide across the dimensions of ESG, environmental, social, and governance. And then they create a score for those companies on each one of those areas, and ultimately that gets rolled up into an overall score, which you see illustrated. For those of us who love visuals, they have provided a rating icon service, so you can kind of look and see if your fund has 4 globes or 3 globes and get a sense for how it does. In addition to, one of the things that I think is really interesting is, in addition to just scoring the company overall on these aspects, they also look at flashpoints. So for example, if your petroleum company does reasonably well overall, on an ongoing basis, but you've got 3 oil spills around the world that are currently dragging, causing huge damage, there's an adjustment that's made to your score for specific events that are happening. And they track over 10,000 of those. So it's a pretty comprehensive way to look at the data. And as you can see, every investment ultimately gets a score from 1 to 5 or 1 to 5 globes. If you get a fund that scores high, you're looking at a fund that's in the top 10% of its category. So what we are doing with all this is trying to combine it with the way that we typically approach building a portfolio. It's easy to get lost in the details of socially responsible investment, we want to make sure that it remains within the context of an overall portfolio that works. So we always would start off looking at what are your financial goals, what are your concerns, and what matters to you. And by the way, I should say this is a lot of this is replicable whether it's with Steward or with someone else. We have a slight leg up in that we've got the Morningstar data to work with. It's important to figure out what your values and beliefs are regarding the ESG criteria, because it sounds great. It's difficult sometimes when you get into practice. I mean, for example, if you are concerned about carbon and reduce and say, you're concerned about investing in oil companies. Well, what do you think about nuclear? Is that the answer to the problem or your biggest nightmare? Or if you're concerned about investing in companies that have social import, what do you think about a company that engages in family planning services in the developing world? Again, depending on your point of view and your values, that's either something that's really important or something to be avoided. And so you have to map out what it is that's really important to you. And we'll get to, in the case study, an illustration of why it's also important to rank order those things and begin to discover what's really important to you. Once you've done that, then we can begin to use the data and find some funds that have the right ESG scores, and look at whether the funds that don't have, or the funds that don't have a specific mandate are also funds that you want to be in, and put them all together into a well-diversified portfolio. And as Tim mentioned earlier, the majority of the effort with SRI at the moment is focused on equities. And so once you get that right, we want to make sure that the portfolio is diversified with bonds and real estate and the other things that you would normally put in there, most of which are sort of value neutral with respect to SRI. So at the end of it all, we want to add a sustainable investing approach as an extra component to what we already do. So with that, I guess we'll transition into a quick illustration of how something like this might work.
Yeah, so I want to walk through just real quick a case study. This is based on a client we were working with. He was in his mid-30s, very ideological. The ESG issues resonated with him, and he wanted to build a portfolio that identified with all the ESG categories. And so he asked us to find some funds that adhered to the values that he held. So we began sorting through the funds. We excluded funds that had exposure to fossil fuels. He was concerned about animal welfare, so we excluded some more funds that invested in companies that did animal research. One of the interesting things he was concerned about was the position of the NFL related to concussion injuries. So he wanted to exclude any companies that dealt with the NFL or advertised with the NFL. So we went through all that and had a very small set of funds left that would actually fit and work in this case. Then he started actually digging into the individual stocks that were held by the funds that we had selected. And as is frequently the case, you can find companies that have had ethical breaches in their past, or you found a company that manufactured in emerging economies. And so we wanted to exclude actually shorting some stocks of companies that had these related issues. So at the end of the day, by trying to go for everything, we ended up with no funds that met his criteria and a very undiversified portfolio. So at that point, we said we need to go back to the drawing board, and we asked, what is really your priority here? What's the most important of these criteria that we want to manage to? And it really came down to he was focused on making sure that his investment portfolio had a positive impact on the environment. We utilized the Morningstar ratings guide. We selected some funds that were focused on carbon emissions. One of the interesting things, just to illustrate how these funds worked, in the bottom right-hand corner, you can see kind of an illustration, a set of funds that we used They didn't completely exclude companies that had anything to do with oil exploration or carbon emissions, but they got rid of the least sustainable companies, so the ones that were polluting the most, and they overweighted companies that were the best performers with the issue of carbon emissions. So it was more of tilting the portfolio. We bought more of good companies and less of bad companies. The portfolio was able to include both domestic and international stocks. We integrated it with some of the other asset classes that we normally invest in, so real estate and bonds. And at the end of the day, we came up with a portfolio that had 50% of the assets that were allocated to funds that had a socially responsible mandate. And the expected return of those funds was very close to what we would expect in a normal portfolio, with a risk that was very close to that. So it was a good outcome, focused on reducing carbon emissions and really still meeting his financial requirements. So at the end of the day, the question is, can you really make a difference by the way you invest? And the answer is yes. First of all, we believe that your financial decisions should be aligned with your values. And so this is a way to align your investments, align your money with your values. Secondly, the demand for socially responsible investing will create more supply, more competition among fund companies to develop these types of products. In fact, just recently we've seen Fidelity and Morgan Stanley introduce some funds that have a socially responsible mandate. Third, company executives listen to the investment community. So to the extent that the investment community is looking for companies that are good performers in these areas, companies will respond. In fact, recently in the news, Larry Fink, who is the head of BlackRock Investments, said publicly that if a company does not have a climate change initiative as part of their overall corporate governance, that he will not invest in those companies. So there's very large investors out there that are putting pressure on companies to change their practices. And finally, the more activity there is in this area, the more robust the information is. So the better quality insights that we can have into how companies are actually performing. So with that, I just want to mention that if you're interested in going further, we can do a couple of things. One is we can look at an existing portfolio. We can use the Morningstar data evaluation tools to score your portfolio. We also have some alternative portfolios that we've looked at that have both a good ESG mandate, but also good performance. So if you're interested in that, give us a call, send us an email, and we'd be happy to go further with that. So now we'd like to open it up to questions, and we've had a couple come in. One of them is relates to a company retirement plan. How do you get access to socially responsible investments in your retirement plan? And there's really two things I would say to that. One is that you may already have funds in your retirement plan that are good options. Even if a fund doesn't necessarily say that it's a socially responsible fund, we can run analytics using the Morningstar tools to determine if they are indeed investing in companies that align with your environmental, social, and governance values. Secondly, you can go back to your retirement plan sponsor. So there's usually in your company a committee or a department that oversees the retirement plan. And the more that employees ask for socially responsible investments in their plan, the more pressure that puts on the committees to add those and provide those as an option. The second question was, how do you find companies that both treat the environmental issues sensitively, but also treat their employees well? And how do you find screens to find companies that meet these criteria. And the short answer is there's a lot available. Just doing Google searches on investment funds, you can find some information on their socially responsible profiles. The other thing, there are tools that are not available to most investors. The Morningstar tool, Sustainalytics data, which is fairly expensive to subscribe to, but there's companies that are now, like Morningstar, evaluating funds and helping folks find funds that meet those criteria. Dale, anything else you'd add to that on the screening process?
No, although I will throw out a question that hasn't been asked. We've done this presentation a couple of times in different forums with different audiences, and the one question that's consistently come up is, what do you think will happen to the whole SRI market given the current political and economic environment? And the short answer to that is that, well, obviously in the long run, that's of course unclear, but in the short run, the answer seems to be not much. That, in other words, the market is continuing to grow. We were passing an article around the office yesterday that showed there was a huge bump in assets flowing into sustainable funds right after the election. So and the number of funds has just exploded. So this seems to be a trend that has some legs, and that is independent of the political environment, and then it will continue. And so yeah, it's been likened to the tech boom or something like that in terms of where it's going.
Yeah, I would say that this isn't just a flash in the pan fad. It's got a long history. It has been growing a lot and has been getting a lot of attention lately, but it's not something that's going away. And the good news is that it's whether you identify with any of the particular criteria, it's forcing companies to report on these issues and creating more transparency and more ability to choose how you invest your money. So I think it's a good thing all around. Again, if you'd like to submit a question, you can use the chat feature. I think one other question we get, and we touched on this a little bit, is does socially responsible investing have a negative impact on your financial returns? And so the question is, if you're limiting your investment universe to a smaller subset of companies and funds that you invest in, does that mean you miss out on opportunities? And what we've seen empirically is that those funds that have SRI mandates have done the performance has been relatively close to funds that don't have that mandate. There's also some philosophical interest in the investment community that is looking at, does socially responsible criteria actually improve the investment performance? And the concept there is that if a company is focused on managing this part of their business really well, they probably also manage the financial aspects of their business well. So, so far what we've seen is that you can get returns that are fairly close to returns that you would get if you didn't have these types of screens. Well, we're not seeing any other questions come in at this point, so we want to just thank you for joining us. Like we said, if you have other questions about this, please feel free to contact us directly. We'd be happy to talk to you in more detail about your individual situation, and we'd love to hear any feedback you have about this topic and about this webinar. So thanks again, and we hope you have a good afternoon. Bye. Bye-bye.